Ladies and gentlemen, good evening. I welcome you to Axis Bank's conference call for a presentation of the bank's performance in the first quarter of the financial year 2019. On this call with me are my colleagues, Mr. V. Srinivasan, Deputy Managing Director, and Mr. Rajiv Anand, Executive Director, Retail Banking. At the outset, we would like to apologize for this late timing of the call, particularly to our friends who are dialing in from Hong Kong, Singapore, or further points east. During this call, we do expect to refer to some slides in our investor presentation, so you might want to keep them handy. Jumping right in, allow me to start with asset quality. Please refer to slides numbered 48 through 56 in our earnings presentation. NPA ratios for the bank improved sequentially in this quarter, with GNPA and net NPA reducing by 25 basis points and 31 basis points respectively. Slippages as well have reverted to a more moderate level after the highs we saw in the fourth quarter of financial year 18. Gross slippages in this quarter were 4,337 crores, of which 2,218 crores was from the corporate segment. Net slippages were 1,420 crores. Slippages came predominantly from our previously disclosed stressed book. Of all corporate slippages in this quarter, 88% came from the BB and below pool disclosed previously. We underwent rating downgrades from BBB into the standard BB and below book worth 4,609 crores in the first quarter. With this action and after these downgrades, we now believe that rating downgrades have now normalized. If you look at slide 52, you can see that with the downgrade cycle being substantially completed, the BB and below book now stands at rupees 10,396 crores, or 2.1% of gross customer assets. This is a level less than one-third of the 7.3% peak that we reached 2 years ago. We have also in this quarter increased our provision coverage on NPAs to 69%. Our steady-state target for PCR continues to be the 60 to 65% range. Let's move now to the bank's earnings. I request you to refer to slides numbered 3 through 18 of the earnings presentation. Net profit for the quarter stood at 701 crores as compared to a loss reported in the fourth quarter FY18. NII for the quarter grew 12% YOY. If you refer to slide number 15, you can see that the net interest margin for the quarter stood at 3.46%, with domestic NIM at 3.67%. This is a material improvement sequentially. It is important, however, to mention that the NIM in this quarter is boosted by a one-off interest item coming from interest realization from recovery of an account from the first list of IBC. As you can see on the same slide, cost of funds has been inching up over the last 2 quarters. If you look at the next slide, you see that the yield side of the equation is also showing strong signs of increase. The bank's MCLR has increased by 35 basis points in the last 2 quarters, and 50% of our advances are now MCLR linked. If you look at the pie chart on MCLR duration, you can infer that over the next few months, existing MCLR accounts will continue to be reset at higher levels of the rate. This dynamic, along with lower slippages and consequent interest reversals, gives us confidence that margins are likely to see decent support through the rest of this year. As we mentioned at the beginning of this year, we expect NIMs in FY19 to be broadly in line with the full year margins of the previous year. Other income, which comprises fee, trading profits, and miscellaneous income, declined 2% YOY. Retail fee income within this grew at a healthy 18% rate. This line now constitutes 61% of the total fee income of the bank. If you flip to slide 17, you can see that the composition of our fee income line has fundamentally altered in recent times, with the contribution of corporate credit-driven fees reducing significantly. Corporate credit, which used to contribute 24% of our fees at the end of the first quarter FY17, now contributes 13%. That contribution has been picked up by our cards business and other retail businesses. With this significant shift, we believe the transition in our business model on the fee front is nearly complete. In line with this business model shift, corporate banking fees degrew by 24% year-on-year in this quarter. Overall, fee income grew by 6% year-on-year. Trading income contribution was much lower from the first quarter FY19 at 103 crores, down from 824 crores or down 88% YOY. This quarter saw a sharp rise in yields across the GSEC yield curve. Consequently, the bank registered MTM provisions of 135 crores during the quarter. We have taken the entire hit in this quarter and have not utilized the RBI dispensation that allowed for taking this over 4 quarters. Operating expense growth for the quarter moderated to 12% YOY. The annualized operating expenses to average assets ratio stood at 2.16%. We continue to be on track for the below 2% number that we have targeted over the next 3 years. Core operating profits rose 23% YOY. Operating profit for the quarter stood at 4,372 crores, up 19% on a QOQ basis, however flat on a YOY basis. Provisions and contingencies for the quarter increased by 43% YOY and decreased by 54% QOQ to rupees 3,338 crores. For a detailed breakup of the provisions, please refer to slide 56. Miscellaneous income during the quarter was 705 crores compared to 173 crores in the first quarter of FY18. This line is made up of 2 major items: dividend payment from subsidiaries and recoveries from written-off accounts. During Q1, we saw some significant recoveries from previously written-off accounts outside of the IBC process, which was one of the key drivers of a higher miscellaneous income during this quarter. This is an important dynamic that is worth spending a moment on. Over the last 4 quarters, the bank has recovered a total of rupees 703 crores from written-off accounts. This corresponds to approximately 13% of our prudential write-off book as of June 2017, i.e. 1 year ago. This is a ratio that we internally call annualized recoveries on a lagged PWO book. As you can see on slide 56, the size of our PWO book at the end of the first quarter FY19 is now 14,832 crores. Let me move now to a discussion on our retail franchise. The retail franchise of the bank continues to deliver well. Overall deposit growth for the bank for the quarter stood at 14% YOY. On a daily average basis, CASA deposits for the quarter grew 15% YOY and comprised 46% of total deposits, a rate at which they have been quite steady over the last 4 or 5 quarters. Savings account and current account balances grew by 18% YOY and 8% YOY respectively on an average basis. CASA and retail term deposits continue to form a strong base of funding, and together they stood at 81% of total deposits. Term deposits had a strong quarter, growing by 19% YOY. Retail term deposits grew 14%, while growth in wholesale term deposits was higher at 28%. Retail fees, as we discussed before, have increased quite a lot and have also become more granular and annuity-based. Cards fee grew strongly by 29% YOY and contributed 43% of overall retail fees in the first quarter. We would also like to highlight that starting this quarter, we have reclassified international retail banking fees, including things like forex card fees, retail remittance fees, etc., from transaction banking to retail banking. We have accordingly restated previous period data. The bank's strategy on retail assets continues to be centered around existing customers of the bank. 69% of retail assets originations in the first quarter was from existing customers of the bank. 97% of the bank's credit cards and 75% of personal loan originations in the quarter were from existing customers of the bank. 47% of the overall sourcing happened through our branches. Given our internal sourcing strategy, we believe that branches remain essential for new customer acquisition and hence continue to make investments in developing an extensive branch network. We opened 76 branches during the quarter with a total network now of 3,779 branches. As mentioned in previous quarters, the newer branches continue to get smaller in size. In the recent past, during our interactions with the investment community, we have received some queries on the trends in asset quality on our retail book. There is some contextual information in this space that you might find useful. During the second half of financial year 18, the bank tightened its process for recognition of NPAs in the retail segment. As per our new practice, accounts are downgraded to NPA immediately on reaching the 91st day of delinquency. Previous to this, recognition happened at the end of the corresponding month in which the account reaches 90 days of delinquency. This new practice accelerates recognition compared to the past. Correspondingly, it also sets a higher bar for subsequent normalization of the account, because now you need 3 EMI payments for the account to become standard rather than 1. This change in practice resulted in an elevation of gross slippages in retail during the third and fourth quarter of FY18, though the increase in net slippages was more modest. The elevated levels have since settled at a slightly lower level, as you can see in this quarter. The retail loan book of the bank is very well diversified, and risk in each product segment is managed very dynamically based on the latest emerging data. Looking at the available early warning data we track in this business, as of now, we are not witnessing any material deterioration in retail asset quality. Let's move now to digital, where our strength and leadership position continue. If you refer to slide 29, you will notice that the bank has a strong market share across most digital and tech payment product categories. Slide 32 speaks to our leadership in the mobile banking space. In mobile banking, as per the latest RBI data, Axis is again ranked number 1 in the country by transaction value. Mobile banking spends in the first quarter reported a growth of 90% on a YOY basis. The bank had 4.7 million credit cards in force at the end of the quarter, making us the 4th largest credit card issuer in the country with a market share of 12%. Credit card spends in the first quarter increased by 51% YOY to 14,414 crores, and debit card spends grew by 28% YOY to 10,169 crores. The bank is the 2nd largest acquirer of point-of-sale terminals in the country, with an installed base of over 0.51 million point-of-sale terminals. We continue to witness strong traction in adoption of digital channels by customers. If you refer to slide 33 in the earnings presentation, you will see that 58% of the bank's active customers are now digitally active. The share of digital transactions in the overall mix has also increased, now getting to 70%, while branch transactions continue to trend downwards in number terms. If you flip over to slide 34, this showcases increasing contribution from digital channels to businesses' growth. 56% of all savings accounts opened are now sourced through tab banking. Also, 31% of personal loans disbursed in the first quarter were originated through digital channels. We launched our online instant savings account offering called Axis ASAP in November 2017. This product has witnessed strong response from customers, with 0.4 million ASAP accounts opened in the first quarter, taking the cumulative ASAP customer base to over 0.6 million in a little over 6 months. ASAP is a key new customer acquisition channel as it primarily attracts customers who are not existing clients of the bank. In the first quarter, 86% of ASAP accounts were new to bank. Slide 36 highlights our capabilities and strong positioning in the United Payment Interface or Unified Payment Interface, UPI space. During this quarter, we saw 79 million UPI transactions with a total transaction volume of 9,706 crores and a 10% market share. We also increased our UPI customer base to 19.9 million. At present, we have 14.6 million virtual payment addresses created across our various apps. Let us now discuss loan growth and the trends we are seeing across various business segments. The bank's loan growth for the quarter stood at 14% and our loan-to-deposit ratio at 99%. The retail loan book continued to grow strongly at 21%, with significant diversification in portfolio mix. If you refer to slide 23, the growth in retail loans in the first quarter was led by personal loans, credit cards, and auto loans, which grew by 41%, 33%, and 27% respectively. Our previously disclosed new engines of growth, like personal loans, small business lending, and education loans, continue to see strong momentum. The momentum in the SME segment continued during the quarter with a 19% YOY loan growth. Term loans and working capital loans grew by 11% and 21% YOY respectively. Share of working capital to overall SME loan book currently stands at 78%. The focus here remains on building a highly rated SME book, and at present, 88% of our standard outstanding exposure is to clients rated SME 3 or better. The domestic corporate loan book grew at 8%. The international book grew at a much slower 2%, in line with our strategy. With a focus on risk management in the corporate segment, we continue to focus our strategy along 4 dimensions: reduce concentration risk, build a higher rated lending book, increase the share of working capital loans and transaction banking revenues, and finally, prepare for a move towards deeper bond markets through our DCM franchise. In line with these focus areas, you'll notice a few factoids on slides 41 through 44. 78% of non-NPA outstanding exposure in corporate lending is to companies rated A or better, compared to 68% a year ago. New client acquisition continues to be focused on highly rated customers, with 94% of new sanctions in the first quarter going to clients rated A or better. On slide 44, you can see that concentration risk in the book continues to reduce. Our exposure to the top 20 borrowers, which at one point of time was close to 300% of Tier 1 capital, has consistently come down and now stands at 118%. Our business mix in corporate lending continues to move towards working capital loans. On working capital loans, we saw growth of 32% YOY in this quarter, as you can see on slide 42. Working capital loans now form 29% of total corporate loans. The impact of all these moves on the risk management front in corporate credit can be seen most clearly on 2 metrics. On the fee side, as we discussed before, this shows up as much more modest fee generation from the lending side of our corporate business. On the RWA front, this shift in strategy shows up as a noticeable lowering of our RWA to assets ratio in the corporate book, which gets us to a discussion on the bank's capital position. The RWA to assets ratio of the bank improved to 74% at the end of Q1. Driven by this improvement, the bank accreted 14 basis points of capital to CET1 during the quarter after incorporating profits in the quarter. The bank's CET1 ratio at the end of Q1 was 11.86%, with a Tier 1 capital adequacy ratio of 13.22. Our capital position continues to be strong and is sufficiently robust for us to pursue growth opportunities over the next 2 years. Finally, let us move to the performance of our key subsidiaries. The bank subsidiaries have started to scale to a level where they are now able complements to the bank's overall strategy. Let me start with Axis Finance. Axis Finance is our fast-growing NBFC and complements the bank's strategy by offering financial solutions to retail and wholesale customers who have unique financial requirements. The loan book of Axis Finance grew by 47% YOY in the first quarter. our important strategic thrust here is to grow the share of retail loans in this book. This share stands at 18% at the end of the first quarter. Axis Capital, our investment banking business, the institutional equities and investment banking franchise, has been a leader in equity and equity-linked deals over the last decade. Overall capital market activity in Q1 was muted, driven in part by increased volatility in the market. Axis Capital, however, executed 5 transactions during the first quarter, including a QIP, an OFS, and 3 advisory deals. Axis Securities. Axis Securities is one of the fastest growing stock brokerage firms in India. It currently ranks number 3 among brokerages in India in terms of total client base. It's also one of the highest mobile adoption rates in the country, with over 60% of the volumes coming from mobile. The cumulative client base rose 29% YOY to 1.9 million. Axis AMC, the mutual fund business, continues to perform well. The AMC reported 25% YOY growth in average AUM for the first quarter, led by 32% rise in number of client folios. InvoiceMart. Axis Bank, in partnership with M Junction, was one of the 3 entities allowed by RBI to set up a trade receivables discounting system, an electronic platform for discounting invoices, thus facilitating cash flows for MSMEs. This is a 3-sided ecosystem platform which brings together buyers, who are typically large companies, sellers, who are typically MSMEs, and financiers that are interested in lending to these MSMEs. The bank's digital invoice discounting platform, InvoiceSmart, has done exceedingly well in its first few quarters of existence and now enjoys a market share of about 40% among all trade platforms. We currently have more than 550 participants on the platform and have clocked more than 660 crores in financed throughput by e-discounting of 29,000 invoices. Finally, FreeCharge. Axis Bank consummated the acquisition of one of the top payment fintechs in the country, FreeCharge, in October 2017. The progress on FreeCharge since then has been extremely strong. Payment throughput is up 68%. New customer acquisition has increased to 3x of its old levels. Monthly active user numbers are up significantly, and spends per user is up 46%. The transaction profile of customers has improved significantly as well, as you can see on slide 67. From a point where customers were largely undertaking just recharge transactions, we now see FreeCharge customers using the platform for many different usage categories, thus making the data footprint significantly richer. FreeCharge is an important component of the bank's strategy in the fintech and payment innovation space, and you will see significant investments in making it a powerful financial platform over the coming years. As I close my comments, allow me to re-summarize some of the key themes of the quarter. The slowing of new NPA formation and the reduction in NPA ratios increases our confidence in the belief that the NPA recognition cycle is nearing its end. Having increased provision coverage significantly, we continue to believe that we should see credit cost normalization in the second half of this year. Core profitability metrics are starting to gain strength. Improved RWA ratios have strengthened our capital position, and we do not expect to need any infusion of capital in the next 2 years. We continue to see strong growth opportunities on both retail and corporate segments, and will pursue them vigorously within the construct of our risk and portfolio thresholds. With that, I come to the end of my opening comments. We would all be glad to take your questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maruk Adajania from IDFC Securities. Please go ahead.
Hi.
Hi, Maruk.
Hi. My first question is on can you give me the non-fund exposure associated with your BB?
2,300 crores or thereabouts. Oh.
Okay. And when you say that the slippages in double B, that is the rating downgrades in double B will normalize, it means that there won't be or there'll be, I mean, you've had a tough look at the book or how is it to be interpreted?
Yes. So you might recall, Marouk, that we have been saying that we have been seeing an elevated level of about 2,500 crores of downgrades from triple B to double B quarter on quarter for the last many quarters. And you might recall me mentioning in the previous quarter that I think there's another 2 quarters worth of downgrades probably in the pipe based on what our understanding was of the weakness in underlying assets. We've gone ahead and looked at all of those accounts in this quarter. And as I mentioned on the call, downgraded about 4,600 crores of that. And that's what I mean by saying that the elevated levels of about the kind of levels that you were seeing in terms of downgrades into double B is pretty much over. And just to go back to my first answer for just 1 minute, Marouk, 2,800 crores is the non-funded exposure, not 2,300. Sorry.
Got it. Not a problem. And then just in terms of probability of the slippages have moderated quite well this quarter. So does it mean that while the watch list has expanded, the probability of slippage now from the overall pool, double B and everything else, is much lower than what you saw, say, in the fourth quarter or even in the third quarter? Is that a fair assumption now?
That's the base case, Marouk, but let's wait and watch. Let's see how the next few quarters pan out, and based on that, we can cement that decision.
And there's a talk on one power account where you are the lead, and the haircut there based on private bidding was some 72 or 73%. Also, on the other hand, banks are working on schemes like Samadhan, to resolve power assets where the haircuts are expected to be low. So, what's going to be the likely resolution? As in that will banks wait for better value to emerge, or will some power accounts, big power accounts, still be resolved at a 70-72% discount?
Outside of NCLT, you need 100% consent of lenders. And clearly, if you look at what's happening through whatever the Samadhan sort of framework, resolutions are unlikely to happen without 100% lender consent unless it's part of that framework or conforms to that framework. So you should look at it that way.
Sorry. So I didn't get. So if it's part of Samadhan, then it's okay. Otherwise, it's an issue.
I think the sort of framework which Samadhan has, all resolutions will fit into that framework.
Okay, but that does not require 100%, right? It just requires 66%. Is that correct? Or of lender consent?
No, it requires 100%. Outside of our NCLT, it requires 100%. February circular.
Okay. Got it. And just a question on corporate loan growth. Sequentially, it has been weak, and even housing growth has moderated. And so has growth in savings deposits. So any particular reason there or just a slack season? How is it going to pan out going ahead?
So overall, from a growth perspective, Marouk, we are you should look at growth of loans and deposits sort of hand in hand. We said that we have a loan to deposit ratio right now at 99%. We wouldn't want to grow loans too far out ahead of our deposit growth. So that is one thing that you should keep in mind. Now, in that context, we will try to chase the growth opportunity where we have the highest return on capital, and that is something that we have pursued over this quarter. Corporate growth opportunities are there for us. Similarly, in retail as well, there are lots of opportunities right now. So purely from a growth perspective, the opportunity to grow in the high teens or even higher is quite high in the market. It's a little bit about the appetite that you want to set for yourself in terms of return on capital and loan to deposit ratio. And different banks will make different choices in that regard. What we have chosen to do in this quarter is what you see in front of you. As we have been talking on the mortgage space, etc., over the last little while, while we love the business and there is a lot of positives to be had in that business, from a return on capital perspective, you want to not have too much of that business, and there's a little bit of emerging niggling concern that we have always had about certain markets where that business might have risks building up. So we will moderate our growth, but this is not strategy that we will hold on to all the time. So it's tactical, depending on what opportunities you see in the quarter at that particular time.
But to improve loan deposit ratio, would you increase your savings rate or rate on term deposits, or how would it pan out?
All options are on the table, Maruk.
Okay, perfect. Thank you so much. Thanks.
Thank you. The next question is from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Yeah, hi guys.
Hi Manish.
So on the slippages front, we had a reasonable amount of higher slippages coming outside the corporate book, especially retail and SME. While some other banks have also seen a similar trend, how are you seeing this trend? Is it a one-off thing, or you think that given a very strong growth over the last many years, retail slippages may see some pickup this year?
Manish, look at the net numbers, not the gross numbers. Your point is right. Gross slippage outside of corporate book has been about 2,200 crores or thereabouts. But if you look at the net numbers, retail and SME put together have had something like 800 crores or something of slippages. So nothing much at all. This has not actually grown a whole lot. I did refer in my comments towards the tightening of recognition practice that we have had, particularly in retail. That elevates the gross number. Materially, and slightly elevates the recoveries as well. So it's a new normal that will get established as this practice fully gets incorporated in our system. That's what you're seeing right now. But the impact on the net level is actually not very high.
Okay. And my second question is on the coverage ratio. Now, since you seem to be comfortable with the 60 to 65% coverage ratio, but now you are at 69% coverage ratio, and probably with some better recoveries likely in the upcoming quarters, does it mean that now you may not want to increase your coverage ratio from where you are, and incremental provisioning probably should be in line with whatever the increase or decrease is on the gross NPL?
Yeah, that's broadly the base case. I mean, you might see a little bit more. I mean, it's tough to be very precise about this, Manish, but yeah, broadly that's the base case. We don't want to be too far out from our comfort zone, but let's see what the next couple of quarters bring. In general, what you're likely to see is in good times we will build up a buffer from a provision coverage perspective and use up that buffer a little bit as we enter bad times. But in general, our comfort zone is going to be 60 to 65.
Okay. And lastly, you haven't given your subs profitability, especially Axis Finance and Axis Securities.
Right. Yeah, so we have not. Actually, there is the way we have actually looked at it this quarter is we have actually looked mostly at the operating performance of all the subs. So let's see, maybe we'll do it on a half-yearly basis or maybe on a full-year basis. We have not fully made up our minds on that. Remember that there are some new subs that we have created, which are where measuring them on PAT isn't actually the best thing to do. So we wanted to actually keep the focus on the operating side of the businesses, and hence for all the subs we have actually made that choice. We will show the numbers certainly, of course, on a full year basis, but maybe on a half yearly basis as well. We need to think about that.
Okay, fine. Thanks so much.
Thank you, Manish.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hi, good afternoon to all. My first question is on the movement of the BB and below. If you look at that number, you started off with about 90 billion at the start of the quarter. You indicated that there's a fresh addition of 46. The slippages suggest that there's been about a 20 billion reduction here, which means that the difference is about 13 billion. How would you explain that?
The 13 billion were upgraded from BB to BBB. I mentioned this, Mahesh, in the previous quarter's call, that in the previous quarter, we had seen one or two upgrades happen out of BB. And I said that, it looks like going forward, you're going to see both downgrades and upgrades from the BB pool, and the upgrade cycle seems to have started as well. You saw that gaining a little bit of momentum in this quarter. You're absolutely right, about 12 to 13 billion rupees worth of upgrades happened from BB out into BBB and above.
And also to continue, if there has been a 46 billion addition, you also indicated that some of it will move from the NPL line to the sub-investment grade as well.
Yes.
How much would that be as
well? This quarter, there isn't anything material.
Okay. The second question pertains to what is the total quantum of NCLT cases that you have, including those which you have and those which is part of the NCLT 1 and 2 and those which you have initiated on your own?
Oh, see, the NCLT 1 and 2 cases, we have about 4,600 crores fund-based and about 400 crores non-fund-based. So that's basically what we have in NCLT 1 and 2. Outside of that, there's a whole host of cases in which we will take the NCLT route over time to try and recover. I don't have a readily available number on that, Mahesh.
Okay, sure. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, guys. Good evening.
Hi, Nilanjan.
Hey, just go back to the same question again. The BB and below. How should we track the number? I mean, at the end of the day, then we'll have to wait on your commentary to see how much of slippages have happened from the top to bottom. Right, because that's where we are more focused on. And if historically this number has been on a quarterly basis 2,500 or on an annualized basis, let's say anywhere between 9 to 11,000 crore, and if you are saying that this is now going to normalize, does it mean on a quarterly basis we are only going back to like 2,000, 1,500 level, or do you expect we'll go to like 500 level? I'm sorry, I mean completely...
Much lower numbers. Certainly not four-digit.
Right from the next quarter, is that what you are saying?
That is what we are saying, yes.
The current quarter, basically.
Yes, correct. That's what we are saying, starting Q2.
Okay, then I'm a bit confused because to an earlier question where you said we want to wait for 2-3 quarters, and I think that's probably the right thing to do, but you said at least on the normalization of credit cost,
yes,
you basically said let's wait for a few more quarters. Then are you not holding on to the normalization of credit cost starting second half of this year?
No, we are very much holding on to that, Nilanjan. I'm not changing that. I actually don't fully recollect what the previous answer was. Let me reframe. As far as downgrades from BBB to BB are concerned, we think that the 2,500 pace was very high compared to what one expects normalized numbers to be. Normalized numbers are not going to be anywhere near that number. They are not going to be 4-digit at all. And we think we are at normal now. After the 4,600 worth of downgrades that we did in the first quarter, I think we are pretty much done with that accelerated pace, and you're going to go back to fairly low levels of downgrades. That's one. Now, second, it's as far as slippages are concerned, slippages into NPA are concerned, we will probably see one more quarter of elevated level of slippages, and then it should come down materially as well. Now put these together with the fact that existing PCR is already quite high, that should get you to a normalized credit environment in the second half.
Excellent. Okay. And to revisit that retail SME gross slippages, I mean, did you just say that, technically we could have gone up to 119 days and not recognized as a slippage in the retail segment?
Right now, the account is recognized as NPA on the 91st day. That's where I'd like to stop that comment.
Okay. But then, if I look at slightly longer, we have just about, I think, 9 or 10 quarters of data that you have given publicly, if I look at the net slippages to gross slippages in the retail plus SME, it's been very, very volatile, understandable. But then how should I look at that ratio, or is it not worthwhile to even look at that?
No, actually, the way we look at it internally, Nilanjan, let me just tell you that, and maybe you'll find it useful, is we look at a net slippage ratio, so net slippage to advances, but smoothed over 4 quarters. Because there is strong seasonality, if you look at it on an every quarter basis, the number will just jump up and down, and you'll find it very hard to actually make sense of it. But if you smooth it over 4 quarters, you will see a very nice, clean, and strong trend on what net slippages to 4-quarter-old outstandings, etc. are. You will find a very strong trend. That's a good metric to keep track of.
Okay, but on that metric, we have actually kind of increased, right? Because yes. That ratio in 16 was roughly about 1.1, give or take. It increased to about 1.4, 1.5 in 17. I'm sorry, 17 and 18.
You're talking gross, Nilanjan. This is not a net number. Net number is actually half of that, half of what you're saying.
Okay.
Half of what you're saying. But you're right. Let me just make the point for you. The net slippage ratio has indeed increased over the course of last year, and the practice change that I was speaking about before is the primary driver there of why that increase has happened. But it's a new normal that it has actually gotten to, and we think it's a better place to be. That even at roughly 1% net slippage ratio, it's a good place to be because you're recognizing a little bit sooner. Your ability to recover will be a little bit more, and generally it's more prudent to actually recognize it at this level.
Got it, Jairam. And the data keeping question, you mentioned about 2,800 crore in the non-funded BB and below. Could I have the same number for the total vulnerable book, which is about 11,000 crore, as well as the NPLs, and if you can, the SME, the 5 to 8 rated book? So 3 data points.
Right. NPAs, the non-fund based book is 3,400 crores.
And this was 1,000 crore last quarter.
Pardon me, say that again?
Yeah, was that 1,000 crore last quarter?
No, it is somewhere around this number. I mean, not materially different from this number.
Okay.
The total NPAs.
Okay, and what about the vulnerable?
The vulnerable book, there isn't much in addition to what we have said on double B. It's pretty much the same.
Okay, and do you have an exposure on the SME side as well?
The SME, what are you looking for? SME?
The rated 5 to 8, essentially.
5 to 8 rupee crore. Just give us a moment. I will dig that number up. Let's carry on with the next question. And
I'm done with the questions. I'm done with the questions, Jairam. Thank you so much. Good efforts. Thanks.
Thank you, Nilanjan.
Thank you. The next question is from the line of Arash Aritna from India Infoline. Please go ahead.
Yeah, hi. Thanks for taking my question. A couple of questions. Number one, could you please give us the breakup of the NPL by corporate, retail, SME and agri? Number two is the non-fund-based power exposure that you've disclosed. Could we please have the rating mix? And also on the NCLT cases, could you give us the PCR on fund-based and non-fund-based?
My God, that's a lot of data. Let me see what we can do there. On your question on power book and rating mix, we've got the overall rating mix of the power book on slide 46. So that is of course on the fund-based business. The non-fund-based I don't readily have, but I have no reason to believe that it's going to be materially different from what this is, what is here. So if you just make the same assumption, you're not going to be way off at all.
Okay.
Your second question was on, remind me again?
The breakup of GNPLs by loan segment, corporate, retail, SME, and agri.
We said that. I thought we had that in our disclosure. There's 4,400 crores or so of total slippages, of which 2,200 or so is corporate.
Sorry, not the slippages. I'm asking the absolute GNPL.
Sorry. The book. Retail is about 2,600 crores, 700 crores or so, and SME is about 2,500 crores or so.
Oh, and corporate would be the rest?
Corporate is the rest, 27,000 something.
Oh, thanks. And lastly, just the provision coverage you have on the NCLT cases, fund and non-fund based.
83%. Fund based, no, everything put together about 80. It must be about 80%. Well, fund based 83%. Non-fund is less than 10% of our fund based exposure.
Okay, thanks. And just one last question. Could you give the absolute amount of the interest reversal that you mentioned, the 17 bips in the slide?
Yes, 249 crores.
Okay. Thank you. I'm done with my questions.
Thank you.
Thank you. The next question is from the line of Anand Ladha from HDFC Mutual Fund. Please go ahead. Anand Ladha from HDFC Mutual Fund, your line is in the talk mode. You may go ahead.
Hi. Just a couple of questions from my side. On the other miscellaneous income, you do provide some clarity. If you can quantify what has been the dividend income and what has been the recovery from return of asset. And also if you can give some clarity, like last year, how much was the recovery from return of pool?
Got it. Thanks for your question. Dividend income is about 130 crores. Recoveries are roughly 400 crores, and the rest is trading income. That's the breakout. As far as total recoveries from write-off over the last year, I mentioned during my call that we have made 703 crores of recovery from write-off over the last 4 quarters. 703 crores.
Perfect. And you just mentioned some trading income. So what was that? So 400 is a return of asset recovery, 130 is a dividend income. So that's 530.
Yes. Roughly 100 crores of trading, 110 crores, I think, trading income.
So that's what... So that trading income is different from the treasury income which you reported of 103 crores?
Oh, yeah. No, this is FX.
Same. It's the same. On treasury and that is the same.
Sorry, one second. I think we're getting confused between other income and miscellaneous income. So in other income, we have miscellaneous income as well as trading income. The breakout I was giving you was of other income. If you're looking at miscellaneous income, there are only 2 items there. The 2 items are dividend from subsidiaries, which is 130 crores, and the recoveries, which is roughly 400 crores. Those are the only 2 items, 420 crores or so. That is the total total amount there.
Okay. Actually, I was talking about the other income, which is 705 crore rupees.
Correct. That other income also includes trading.
Okay. And what was the corresponding number last year, same quarter?
997 crores, I think. Now, the total trading and miscellaneous total was 997.
Okay. And last year, what was the dividend income for the full year?
I don't know. We'll try and dig it up, Anil.
Fine, thank you.
By the way, while I have to also correct myself on something. My team points out that during this call last quarter, when the question came on non-fund based exposure to NPL accounts, the transcript on the website seems to suggest that I said it's roughly 1,000 crores. There might have been a transcript problem because I said 3,000 crores. It might have not gotten caught. I want to correct myself. The non-fund based exposure is 3,000 crores on NPA, not 1,000 crores. Last quarter's transcript.
Perfect. That's from my side.
Thank you, Anil.
Thank you. The next question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good evening, Jairam. Just a question on power sector. In the slide number 44, you have kind of hinted that the coverage, slide number 46, the coverage is around 42%.
Yes.
But the net NPA is 30% and gross is 42%. The coverage seems to be 29%. So how have you calculated that?
There must be some write-off as well from the full pool.
Which implies that the gross NPA, if we kind of add it back, would be much higher than, say, 50%. So is it safe to assume that?
Yes.
Okay. Thanks. That's it from my side.
Thank you.
Thank you. The next question is from the line of Vishal Goyal from UBS Securities. Please go ahead.
Hi, Jairam.
Hi,
Hi, thanks. So the question is actually on the whole this news around RBI QR and the list of 240 accounts. I don't know how much of it is true, but can you give some color on what is actually happening and what can be potential impact for us?
Yeah, Vishal, we have not heard anything about it. I mean, the ticker is the first thing we heard on this issue. We have our annual RBI inspection, and that will largely happen during this quarter. So far, we have not heard anything of this nature, and certainly no official communication that I'm aware of. So, to be perfectly honest, this is somewhat news to me, and we've got to figure out whether there is some fire where the smoke is coming from, or is it just all smoke?
Okay. Could it be just the annual inspection which is happening now, throughout the bank?
Yeah, that's what it seems to be, but there is no meta list of 240 accounts or anything that I'm aware of.
Okay. And so maybe I think that the 240 list, we can keep it aside. For our bank, since we have already disclosed BB and below and, all the NPAs, any impact or potential impact of annual inspection you see, outside of what we are discussing already?
I'd be very surprised if there is. In general, the weakness in accounts we've tried to capture as closely as possible in the ratings, which we have all been talking about. So even if accounts are not classified as NPA, the fact that they are BB is well disclosed to you all. Whether someone's going to find weaknesses outside of the BB list, I would seriously doubt it. But never say never. Let's just wait for the RBI process to get done, and we will get to know for sure.
Okay, thanks. Thank you.
Thank you, Vishal.
Thank you. The next question is from the line of Manish Shukla from Citigroup. Please go ahead.
Yeah, good evening and thank you for the opportunity. Just going back to your PCR target, that is including the write-off number, right?
Yes, it is.
So the specific coverage, if I exclude write-off, is around 54%, then it's fair to assume that that number is unlikely to move up meaningfully from current levels.
See, the way, Manish, you and I have spoken about this in the past, our belief is that when an account becomes fairly high LGD expectation, we tend to move the account to 100% from a provisioning coverage perspective and then do a provisional write-off on that just to get the appropriate tax benefits on it. So it is our belief that the only appropriate way of looking at provision coverage is including all those accounts on which you have made 100% provision, because those are indeed your worst accounts. And that's why we tend to disclose and talk about and internally monitor PCR, including PWO. So we will continue to monitor that. The PWO book itself will likely continue to increase as we write off some more over the next couple of quarters. But that overall coverage is what we are talking about when we say targeting 60 to 65.
Okay, and if we refer to slide number 53, if I just hop on that a bit more, then if I take the total stress pool as gross NPA plus vulnerable, then the specific coverage number, which is 54, looks more like 40. And that is where this question was coming from.
But Manish, that math, what you're essentially saying is that the probability of default of the vulnerable pool is 100%. That is implied when you add GNPA and vulnerable pool, the implication is that the PD is 100%. Now, you could make that choice, but I'm saying at least you would want to do some sensitivity analysis around that and think about how big a BB are you going to have even in end state. It's unlikely that in the end state, the bank has a BB pool of 0, right? So there's always going to be something there, and that's the sensitivity analysis that one should do. So, or another way to say this is, take the GNPA, multiply a PD to the vulnerable pool, and then look at the overall coverage. That would work too.
Okay, fair point. Lastly, on your power sector exposure, all your gas-based exposure is NPA. Is that fair assumption? Because there's no gas in this slide number 46.
Yes.
Okay, all right. Thank you.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
So firstly, in terms of this entire performance on the SME side, so how have been the downgrades out there if we look at it towards, say, the lower rating? So we had seen in terms of few downgrades coming in on the corporate side, but how would have been the behavior on the SME?
Nothing very material, Kunal. We didn't see any significant significant. No, he's talking about rating downgrades. You're talking about rating downgrades, I presume.
Yeah.
We haven't actually seen anything material on that front.
That pool is relatively behaving.
Yes. At this stage, yes, but we are watching it very closely. I know there's been a lot of chatter on this, and it is appropriate for there to be chatter, given some of the stress that this segment, particularly the lower end of the SME segment and the more cash-dependent part of the SME business has been. Our business has largely been towards what you can call organized sector SME, so far we have seen less of an impact on them from demand and GST, but we are watching that space closely.
Okay. And second, in terms of this normalization of credit costs, which you highlighted last time of 110 basis points, so that very much continues in terms of the guidance for the second half.
Yeah, we have continued to use the language of normalization of credit costs. You're right that the last 16-year average of annual credit costs for the bank is 110 bips. Somewhere in that vicinity is where we believe normal is.
Okay. And in terms of the domestic corporate growth, so there has been the moderation. So what's the outlook out there, maybe in terms of now, maybe larger part of stress being identified, being classified, and maybe provided for as well. So what is the outlook on the corporate credit now?
I think what we've been doing is to focus on the highly rated corporates. I think if you look at the rating distribution, which on the standard book, that clearly reflects that. And the opportunities which we get in that bucket is surely something which we'll go aggressively after. And that's what we'll try and do.
Okay. And maybe just one last question. In terms of this downgrade, so were there any large ticket items in this when we look at the downgrade towards the BB and below, and that's the reason maybe some cases which were there at the borderline that has finally happened, and now we are pretty confident that now we'll not see any major downgrades towards BB and below?
Yeah, the latter of what you said. I think there were a bunch of cases which we have been watching closely, and with the turn of the financial year and their numbers from the previous quarter being available, we evaluated them and in many cases chose to downgrade them to BB. These are not any specific large accounts that we are targeting. It's just the full pool and just taking a good hard look after seeing their Q4 numbers at what might be the case. The bulk of the accounts here are going to be in the 100 to 250 crore kind of range. That's going to be the biggest part of the value here.
Okay, 100 to 250. Okay. Okay, yeah, thanks a lot and all the best.
Thank you very much.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential Asset Management. Please go ahead.
Yeah, thanks for taking my question. Just a quick question. What is your SMA1 and SMA2 book right now, and how has it trended, if you don't want to quantify it?
Yeah, we have not disclosed trends of SMA1 and 2. I had mentioned the last time that our SMA2 book is around 50 basis points of loans. That continues to be true in this quarter as well.
And what about SMA1?
SMA1 we have not talked about in the past, so I'd rather not make a specific disclosure here.
So, just because it will elicit a lot more confidence in us, given that BB and below book has increased, if you can comment on this a little more, maybe one of the other corporate banks has clearly given us SMA1 and SMA2, and that inspires confidence.
Sure. That's good feedback, maybe from next quarter.
Sure. Thank you so much.
Thanks.
Thank you. The next question is from the line of Krishnan ASV from SBI Cap Securities. Please go ahead.
Yeah, hi. Just to take you back to the commentary that you made on the retail portfolio. Just wanted to understand what triggered the change in Axis Bank's approach in terms of impairment recognition as well as higher threshold for upgrading these accounts.
No, basically it's a question of recognition. On the corporate side, it always happens on the 91st day. We decided to make it uniform for the retail side too.
And as far as the recognition is concerned, it's once an account becomes NPA, automatically the upgrade requires
all irregularity to be cleared. So 90 days irregularity is 3 EMIs.
So that's not a specific choice on our part. It is an artifact of a quicker recognition. Hello, Krishnan, are you still with us?
Yeah, hello.
Yeah.
Yeah.
Did you get that?
No, I did. Now, all I'm trying to understand is what triggered this change in approach. what did you observe in the retail book that triggered this change in your approach?
Nothing really. Like, we just want to be ahead of the curve.
Okay, got it. The second thing, my second query is around, retail book, the granularity that you're building in your retail book as well. Could you just throw some color on the internal customers that, there are certain asset classes where internal customers are not a very big part of your portfolio. So just wanted to understand how you're chasing customers in these portfolios.
So the book is, like you rightly said, is predominated at serving existing customers. And even from a channel perspective, the focus is to increase the amount of business that we are generating from the branches. So therefore, if you look at those numbers, today about 70% of the customer base on the retail lending side comprises existing to bank customers, and a little under 50% of the business is sourced from the branches. Having said that, obviously, the unsecured side of the business on credit cards, on 97% of the business is sourced from existing customers. Similarly, on the personal loan side, it's close to 75%. However, for home loans and auto loans, that number would be about 50%.
Got it. Thanks. Thank you.
Thank you, Krishnan.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang Securities. Please go ahead.
Yes, sir. Thank you for the opportunity. My question on the operating expenses growth and the branch addition outlook going ahead, because now this quarter we have added 76 branches. So what kind of branch addition we can expect, and secondly, operating expenses growth in the FY19?
Sure. Rajiv, why don't you take the branch addition?
I think, last year as well, we guided that we would be opening about 400 branches. That's the number that we did last year. The expectation is that the number for this year as well would be in the vicinity of about between 350 to 400.
And as far as OPEX is concerned, you saw our OPEX grow 12% YOY, which is one of the lowest growths that we have had in the last many quarters. You saw our cost to assets ratio, or OPEX to assets ratio, fall to 216 basis points. If you recall the presentation that we had uploaded last quarter called Execution Strategy, in that we had said that from the 217 basis point cost to assets annualized, over the next 3 years, we want to come down to 200 basis points or lower, i.e. eke out about 17 basis points of cost efficiency to assets over this 2 to 3 year period. You saw us come down 1 basis point on that path in this quarter, and we expect to continue to go down that path in the forthcoming quarters as well.
Okay. The second question I have was on this the credit cost, which long-term credit cost of 110 basis point. In your comments about two comments, one is your slippages will be significantly lower than the last year, and secondly, the credit cost normalization. So it is fair to assume our full year credit cost will be under 2% or close to 2%?
Yeah, I'll let you do that math. I think we are going to have elevated levels in the first half, and then we're going to come close to normal in the second half. I don't want to add any further guidance on top of that.
Okay, sir. Thank you.
Thank you very much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Jairam Sridharan for closing comments.
Thank you very much, everybody. I know it's quite late. Thank you for being with us on this call. We hope you have a very good evening, or what's left of it.